The whole point of an ISA, which stands for individual savings account, is that any money you have held in this ISA, in this type of account, will be tax-free on profits. So the money itself, you're not paying tax on that. You've already done that when you earned it for whatever reason. But then any profit you make, that could be interest on savings. It could be a dividend that's issued. It could be when you sell a share and you make a gain on that. Any extra money you make on that, any profit you make is tax-free. Which sounds amazing, right? It sounds kind of like, well, obviously you've answered your video there, Andy. Of course you want an ISA because you don't want to be paying tax on your interest or on your profits. However, for most people, they actually haven't had to pay tax on any of those things on money held outside of an ISA. Personal savings allowance, the start to save allowance, the dividend allowance, the capital gains tax allowance, they've all kind of meant that it doesn't really matter where your money is for most people. Obviously, we're always going to be exceptions, but most people, they're going to be absolutely fine wherever their money was. And ISAs haven't been that important. There's also premium bonds you can throw in as well because their prizes are all tax-free as well. However, there are some changes coming along at the start of the new financial year in April 2023, plus some other kind of general movements going on in terms of interest rates, which might actually change that for more people. So I think it's worth going through in this video exactly what those changes are going to be. So you know the changes to allowance or the pressures on some of those allowances. And let's start with savings first of all. There is obviously a much bigger pressure on something called the personal savings allowance. Again, a whole video you can watch taking you through that in detail, how it works. But fundamentally, very quickly, if you're a basic rate taxpayer, you can earn £1,000 interest tax-free outside of an ISA. Okay, even your money in an ISA doesn't even count towards this. If you do have someone in an ISA, £1,000, that's a lot of money. If you're a higher rate taxpayer, that reduces down to £500. If you're an additional rate taxpayer, then it disappears completely. And for most people, this personal savings allowance has been fine. And that isn't changing. At least fingers crossed, it's not changing. We do have a budget in March 2023. You never know, they might announce something there. But at the moment, that's staying as it is. The problem you've got is that, well, it's a good problem to have. Interest rates are going up on so many savings accounts. Easy access accounts, at the time of recording this, there are plenty above 3%. There are regular savers at 5, 6, 7%. There are a number of decent paying accounts right now. So if you do have larger sums of money and you're getting the best possible rate you can on those, maybe amongst a combination of different accounts, then it's going to be more and more likely that you actually do start to go past your allowance. Now remember, if you go past your PSA, you only pay tax on the interest earned above it. Okay, so not necessarily means that suddenly all of it is just the money that goes above that allowance. But it's worth knowing that as these interest rates increase, you might be thinking, hang on, do I want to avoid tax on this one completely? And one way to do that is via an ISA. Another interesting thing to think about here is about fixed savings accounts. Often, these ones for 1 year, 2 years, 3 years, whatever it might be, often they pay out monthly, often they pay out annually. Sometimes they'll pay out at term, which basically means when that fix finishes. So if you have got a decent amount of money in there, getting a decent rate of interest over a number of years, then that will, when it's all paid in one lump sum, will really eat into that PSA. So for example, the recently increased NSNI green savings bonds, they're a 3-year fix at 4.2%. If you have £8,000 saved in those, you will get just over £1,000 in 3 years' time. That wipes out the entire PSA for that year, assuming that you are a basic rate taxpayer. Any interest you then earn on other accounts in that year, your easy access accounts, your regular savers, whatever it might be, is suddenly going to get taxed at your marginal rate at 20%. Obviously, if you've got a lower rate, £500 personal savings allowance, then it's at 40% anything you make. So again, good reasons here to think about how much interest am I earning? How much am I likely to be earning if rates continue to increase or I continue to save more money? The other pressures that are coming on savers as well come down to some freezes on our thresholds, our tax thresholds. So the big one here, they're not going to change until 2028. So they've been frozen for 5 years from now. Obviously that could change, new governments coming with new policies, but that's the plan right now. And that basically means that if you get a pay rise or you get a promotion or a new job with a higher salary, whatever it might be, and you are already close to the thresholds. And the important one here is probably that £50,270 annual salary threshold, which moves you from 20% tax to 40% tax, from a basic rate taxpayer into a high rate taxpayer. All of a sudden, when you move into that, and there's a greater chance you'll do that if you're already around that mark, if you do get increases to your salary, then your PSA drops down to £500, as I said. Well, that could have an impact, couldn't it? So suddenly you're losing how much interest you can earn tax-free. And the last one here, the last kind of impact, is not going to apply to many of you, but it's worth sort of pointing out. This is around the additional rate taxpayer. This was announced back in the autumn last year, and it's going to come into play on April the 6th of 2023. And this is the additional rate threshold. So when you pay 45% tax and you get no PSA, no personal savings allowance at all, that is going to drop from £150,000 a year to, let me get the exact figure here, it is £125,140 a year. So again, if you're already earning, let's say you're earning 130k right now, at the moment you'll have a £500 PSA. In a month and a bit's time, you're not going to have one at all. And again, if you get salary increases that push you over that thing, that will disappear as well at a much sort of more sooner rate than you would anticipate otherwise. So those things are all going to have an impact on your PSA. We'll come back to that in a minute, what I think you should be doing there. But let's go back to investments. Now, if you're a regular viewer of the channel, you know I don't really talk about investments, but I'm going to talk about them in very broad strokes here in terms of what the changes are to the allowances and some ideas of what you can do. As ever, I would suggest you go and do a lot more research. You should do it anyway. Anything that anybody says on YouTube, you should be double checking it elsewhere. But particularly make sure that if you are going to make some changes on the back of this stuff, that you are fully aware of what they mean. So as I spoke about at the top, there are a couple of allowances that give you profits and dividends tax-free, at least for a certain amount of money from your investments. First one of these, the dividend allowance, that's currently set at £2,000 a year. A dividend is basically some shares, not all of them, but some shares, maybe they've had a good year or whatever it might be, they want to give you, they pay out from the profits, they pay you a little bit extra money which goes to the shareholders. And you don't have to do anything with your shares, you just get these, okay? This limit is currently £2,000 and that's quite a lot. So again, for most people, that's been relatively fine. The only people where maybe it's been a bit of an issue is obviously you can get dividends if maybe you're own a limited company and that's how you pay yourself, a few other things like that. But most people, £2,000, it's going to be okay for your investments. From April of 2023, that is going to go in half to £1,000 a year. And then the following April, half again to £500 a year. Now, again, it might not be too much of an issue for most people, but if you maybe have been saving or investing for a long time and you have a lot of money saved up there, invested away, and a lot of them in dividend paying stocks, maybe you're relying on it. That's how you get your kind of income at a later age. Then this is something to be concerned about because obviously you're going to be suddenly paying whatever your marginal rate of tax is on another sort of larger chunk of your money you received. Capital gains tax. This is another allowance that you've got. Currently sits at massive, absolutely massive, £12,300. Really, really, really huge there. You basically only pay capital gains tax on profit. So if you sell your shares and you've made money on them, that's when you would pay capital gains tax. Although if you've made any losses on other shares, you can use those to kind of balance it out. So that might reduce how much how many gains you've actually made. And that's when we talk about stocks and shares. And a £12,300 allowance is broadly, again, going to be fine for most people. Unless you have lots and lots of money invested or something's gone really sort of stellar, you're unlikely to be making that kind of number of gains for most of us. I appreciate there are people where this does apply. That limit is already not enough. However, you've got to remember as well that capital gains tax is also paid if you have a second property that you sell. Again, not many of us have a second property, but if you do and you sell that, that will be allowance will eat up a lot of that again on the profit that you make between when you bought it and when you sold it, or I know expensive art or wine, anything basically that's expensive that has appreciated in value. When you sell it, you pay capital gains on it. So that allowance, £12,300, for most people going to be fine. That is going to half again, more than half actually, is dropping from April of this year to £6,000. And then the following year in 2024, it will drop down to £3,000. So again, that's still quite a lot for most people if you haven't got a huge amount invested to be worried about. But it is going to make a difference potentially to you if you are going to be selling shares at some point, changing your portfolio as you get older, maybe to take out the risk that's involved in them. And again, you don't want to be paying tax if you can avoid it on those gains. And when that allowance, that capital gains account goes, there's a much greater chance that you will. So what do you do then? If these allowances are coming along, does it mean now we should throw all the money into ISAs instead of the other accounts that have normal savings accounts or general investment accounts? It's obviously going to depend on you and your situation and how much money you have in those types of accounts, but also how much money you plan to put into those in the coming years. I'm going to ignore kind of help to buy ISAs and lifetime ISAs in this sort of thing. We're just talking here more about just broader stocks and shares ISAs and cash ISAs. And let's stick with investments, which since we were just covering that. What do you do with your money there? Should you be putting money into a stocks and shares ISA rather than a general investment account. I mean, I think it makes sense, to actually do that anyways. If you're opening up a new account for investing, to put it in an ISA, because although there will, I'm sure, be some restrictions, maybe certain shares or certain types of investments you can't get in an ISA, in which case then you'll have to have them outside of an ISA. But most of the general things, most of the general funds that most of us do, and if we're just doing tracker funds, which is broadly kind of like the good advice for most people, you're going to be able to get them in an ISA. There might be sort of variations in the fees as well, so you have to play that, put that into account as well. But broadly, put new money into an ISA, an investment stocks and shares ISA, and then if you do make any gains, if you do get any dividends, you are protected. Okay, so it's win-win there. If you have money already in investments that are outside of an ISA, then you might want to, and again, this is where I say you should go and do some more research, you might want to do something called bed and ISA. And bed and ISA is basically where the shares are sold in their current form, and then they're rebought in an ISA. Now, there are going to be some fees for doing this. I don't think there's going to be anything too substantial. There might be some stamp duty, but you have to sort of factor that in as well. And there is the risk, obviously, in the time it takes for the shares to be sold and then bought again, which hopefully isn't going to be too long, but there could be sort of some fluctuation in value there. So you might be buying at a higher price. There's always a risk that that happens. But if you do have some money that you can move over now from a general investment account into an ISA, then you are protecting yourself against that capital gains allowance cut. You will have to pay capital gains tax on any profit that you get from when you sell them in this bed and ISA process. Okay, so let's say you've made 10 grand profit in those ISAs when you do bed and ISA. As long as you haven't used your capital gains tax allowance anywhere else, where in this financial year, in the 2022-2023 year, then that is still going to be tax-free. So you won't pay any tax on that at all, and you'll move it over, and it's in an ISA, and then any future gains, any future dividends, they are protected. Now, obviously, if you do that next year, then it's £6,000. You do it the year after that, it's £3,000. That's the allowance in terms of the profit you can make. So it would make sense to move as much as you possibly can right now without going over your capital gains tax allowance. It's obviously also worth remembering you can only do this up to that £20,000 anyway in terms of the total amount you move over. So you might actually be restricted, probably most likely to be restricted there anyway. So that's maybe a good thing to be thinking about there when it comes to your investments. When it comes to savings, again, it really does depend on how worried you are about the personal savings allowance. If you think that you are going to get a pay rise that pushes you into a higher tax bracket, or if you already are a higher or additional rate taxpayer, if you have large sums of money already and they're earning a decent rate of interest, or perhaps if you have some of those long-term fixes I spoke about where the money is going to be paid all in one big chunk of cash later on, then they are all reasons why you might go over your personal savings allowance, why you might want to think about moving some of that money or new money, new savings into ISAs instead of accounts elsewhere. But remember what I said earlier on, you only get taxed on the interest above the personal savings allowance. You get taxed out of your marginal rate. So this is more important for people who are higher and additional rate taxpayers. But if you're a basic rate taxpayer, you might find that 20% tax on the interest that you've earned above your PSA is still more than you'd get by putting it into an ISA. Or it's marginal, there's not much in it and you don't really need to worry about it. Obviously, as I say, the higher taxes you pay, 40% off is going to make a difference. So you probably do want to be looking at putting money into an ISA there. And another thing, a third thing to think about here as well, whether you're investing or whether you're savings, is who knows what could happen in the future. An ISA can be a good way just to ring fence some money right now, because that money, once it's in as ISA, as I said, it stays within that protection, that tax-free bubble. So getting that money in now, in this financial year or next financial year, while the current rules are here, could mean that you're protected later on. And if they were talking about marginal differences between the rate you're getting on savings in an ISA and savings outside an ISA, then maybe it's worth doing that in case, and who knows what will happen, but maybe in the future they will reduce or scrap the personal savings allowance. Maybe they will reduce how much money you can have, new money can go into an ISA every year. Maybe they put a cap on it, a limit to how much you can put in total. Putting money in now might help you combat that in the future. So that's something to think about there. And interestingly as well, when it comes to investing, let's say you're not investing right now, or you need access to cash right now, so you don't want to invest it, but you maybe later on, you do want to move it over. Having that money in a cash ISA still ring fences it in an ISA. you can then use that money to invest within an ISA. You're not having to take the money out and put it back in. So you can do that without going into a new year's £20,000 allowance. Although, of course, the important thing to kind of probably end on here is £20,000 is still a lot for most people every single financial year. So if that doesn't change, then really you're probably going to do a mix of these things. Some money in a cash ISA, some money in a stocks and shares ISA, or combination, the lifetime ISA and things like that over there as well. And then carry on getting the best possible rate you can elsewhere to maximize your return. My name is Andy Webb. Thank you so much for watching. If you want to find out about the best paying savings accounts, check out these videos right here.